Hello, everyone. Today on the final bar, my guest is Larry Tentarelli from the Blue Chip Daily Trend Report, bringing a couple charts we may want to be paying attention to. We've talked about this sort of growth versus value, small versus large, all these relationships and where to look at. We're going to focus on sentiment today. Thursdays when a lot of the sentiment readings come out. I spike back to what I may characterize as euphoric levels. We'll look at the charts together. You decide how optimistic these look. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a snowy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the lens of technical analysis, behavioral finance, investor psychology, sentiment, breadth, price, momentum, trend, whatever we can bring to bear to make sense of things. I'm super excited to have Larry Tentarelli back on the show. He's one of my favorite chart analysts. It sends a lot around social media, always with a couple charts that I wish I would have found on my own. That's how which is a huge compliment, hopefully, that you can tell by what he's able to bring to the table. Thursday's sentiment day, and while the markets have been choppy yesterday, choppy again today, overall the sentiment readings have actually pivoted pretty heavily this week. Most things come out Wednesday through Thursday. So we're going to take a look at some of those. And, one of the things we've talked about has been euphoric sentiment that's come down to more optimistic levels. I would argue this week we've sort of gone back very quickly and stepped on the accelerator. You're seeing frothiness in a couple of places, but sentiment readings in particular look sort of compelling here. Now, we have great guests coming through the show. I'm very excited to bring you my conversation with Larry in a moment. Next week, we have more fantastic guests. Gary Dean from sentimenttiming.com joining us on Tuesday, the 16th. On Wednesday, the 17th, Peter Brandt. And then on Thursday, Ryan Dietrich from LPL Financial. And it's funny, as I'm just actually recorded earlier today, an interview with Peter Brandt. We're going to be doing a special second season of Behind the Charts, which will be coming for you starting about on March 1st. We'll do a weekly show where we share some behind the scenes conversations with some of the top technical analysts, strategists, traders, and I'm super excited. We had a lot of fun talking with Peter. I also talked with Jason Geffert from Sentiment Trader, both of them. Peter grew up in Minneapolis in the Minnesota area. Jason is up there now. And I was laughing as it's snowy. I keep saying snowy Redmond, Washington. We were buckling down for Snowmageddon, which is about 4 to 6 inches of snow. But for Seattle, where we're not used to getting snow and the roads are not treated especially well for that, we have a lot of hills and mountains. Snow can be kind of dangerous. So we are bracing ourselves for a minimal amount of snow. And my guest Larry here from the Boston area will probably appreciate. We can deal with a lot more snowfall if we're used to it, I'm sure. Let's get to the market recap and focus on how these trends have evolved. As I described yesterday, I sort of called it a digestion day. I'd probably classify today as more of the same. For me, the market moves in 3 directions. It can go up, it can go down, it can go sideways. And these sideways days after a big, rally, which is what we've seen, we've rallied into this week. And now we've seen a couple sort of choppy sideways days. What that tells you is essentially the market nets out at an equilibrium level, right? You had energy stocks down today. You had technology stocks higher. Overall, the average was about flat. And that's kind of where the S&P netted out. So 2 days, we really haven't gone anywhere directionally. It's been a minimal percent change on the S&P. Having said that, there are stocks making moves, and there are stocks gaining and stocks losing, stocks struggling. And again, I think there are plenty of opportunities now more than ever for stock picking, for focusing on the charts that are working, leaning into those, and leaning away from the ones that are not working. We'll do our best to highlight some of those today. So overall, S&P finishing flat, a little bit above 0.2% or so to 3916. Mid caps and small caps both up a little bit more. None of them significantly, though. Overall, it was a relatively quiet day. The VIX back down, testing the 21 level. Other asset classes very quickly. Bonds weaker through the course of the day. They had strengthened into the close yesterday using the TLT, down about 0.5% today. 10-year yields back up around 116. Looking at commodities, we have gold down, silver essentially flat. So Gold is a safe haven, not necessarily feeling that recently, as you've seen the GLD continue to go lower. And we've talked about that overall sort of stagnant sideways to downtrend that we've seen in gold, and that appears to be continuing. Cryptocurrencies overall a little stronger than yesterday, with Bitcoin closing above 47,000 for the day here. Let's go to a chart of the S&P, and we'll look at some of the other things. Again, we won't touch too much on sentiment now, because a segment in a little bit called Getting Sentimental will dig into things like volatility and survey data and others, put call ratios as well. So let's focus on just the overall trends. The S&P, of course, going through this stepwise motion, the rally into the September peak, the consolidation phase in September and October, the breakout of that pattern in November, and then the follow through at the end of November, getting above those September highs. From there, it's really been long and strong up and to the right, with the notable exception of this pullback to the 50-day at the end of January. Since then, back up to new highs, new closing highs. Recently, a couple of days ago, a new intraday high yesterday. We didn't quite get back up there today. Today was more of a chop around here. So, in the very short term, after this rally off of the 50-day moving average, you've had about 3 days after Monday's high close, where we've sort of been choppy. We've made a new intraday high, but overall, it's been sort of sideways. Really haven't gone anywhere since that final push higher Monday, coming off of the weekend. So obviously looking for bulls to regain control and push price out of this congestion range that it's been in, or we rotate lower. And again, the good news about rotating lower is we have our cup runneth over with support levels to look for. You have the 50-day moving average around 37.65. You have the most recent swing low around 3,700. Those would be the first two key levels I would look at. And then also you have the December swing lows, which we've talked about for a little while, sort of the top of this green shaded area. So plenty of support, not too far from where we're at. So if you do pull back, I think there are plenty of opportunities for the S&P to regain its footing, resume an uptrend, and it'll still, if you zoom out, look like just a consistent, nice, strong rally. We start to get below some of these levels, and I think that 38.2% level may be the first one to start to look at. Then we need to be a little more concerned. 3,700 may be the first level I would think about with that swing low from the end of last month. In terms of other themes here, very quickly, as I mentioned, technology, one of the sectors up through the course of the day. A couple of these sort of moved a little bit higher going into the close, healthcare and a couple others, but overall is sort of flat to down. Energy on the at the bottom of the list, followed by utilities, followed by both the consumer sectors, sort of lockstep there at the bottom. In terms of group themes and what sort of movements we had, interesting to see semiconductors back at the top of the list. So even though the S&P was flat, if we look at the SMH, which is the one of the semiconductor ETFs, a nice resumption of this uptrend. Did not hit its 50-day at the end of last month, but now resuming an uptrend, breaking above its January peak. The relative strength making a new 12-month relative high. This is a key group that I've watched for years as sort of a bellwether group. This group tends to do well in bull market phases. It tends to not do as well during the bear market phase. Sort of a good bellwether group to watch. And overall, this making new highs, pushing higher, almost 4% today on a flat market day. Overall, I would bucket in the encouraging column overall. On the downside, what was struggling today, Brewers, it was one of the worst, and you can see TAP here, Molson Coors, gap down today, closing just above 44. That's a tough move after, and again, the big, I think, signal was when it went to break out at the end of January and failed. You had sort of this distribution, one big up day, one big down day immediately afterwards. From there, really hasn't looked back. Most days have had a lower high than the previous day. And then this is a gap down that takes us right to 44, which is the low from December. So I think if you're eyeing support on a stock like this, I think we're right at that point where you sort of look and see if 44 is able to hold. If so, could be pretty encouraging, and you buy in on another leg higher. It's nearing an oversold level right as it hits previous support. If it breaks 44, I think you really have to be concerned about a potential retest of the previous lows down to 32.33, which would be obviously a pretty strong further down move. That's another 12 points below where we're at right now. As you probably know from watching the show, this type of chart is not my favorite. I'd much rather buy things rotating higher than rotating lower. So I think it's concerning, a chart like that that's now testing support. The question is, does it hold? I think that's the level that I would certainly be watching. Lumen Technologies is another one. This is the old CenturyLink ticker that changed. This is the Seattle Seahawks play at Lumen Field now, I think it's called. And same thing, a day like this, certainly a concern similar to Molson Coors. We're testing support. This is something that had a nice run at the end of January, sort of this, exponential rise to the upside, gave it all back very, very quickly. It appeared that trend was going to continue higher, but giving that back, this was an earnings name this week. So now testing support once again. So on these stocks that have an earnings miss, take two is one we talked about earlier in this week. It's always important, I would argue, to look left on the chart, see where we're at relative to those key previous levels. Are we able to hold these levels? Because this is where some cohort of investors bought in when the stock pulled back to around 1150 and rode this price back up there. Are we adding to positions here, or are we getting out and cutting our losses and minimizing the chance of a steeper capital loss? If we break that, all of a sudden we're getting down to like $10 a share, down to the 200-day moving average, and that's the next sort of key level I would look at. So I'm often asked around earnings, does it make sense to look at charts? I would argue, of course, I'm super biased by what I do professionally, which is looking at charts all the time. But I would argue is there's no better time, because it helps give you a sense of where we're at relative to previous price swings. There were reasons why, and investor behavior changed, why valuations compelled people to adjust their positions. And so I think the market has a memory. It's important to pay attention to some of those themes. Overall, finally, just the last comment I wanted to make, if you follow these non-US ETFs, things like the MCHI, the FXI, these have all continued to rotate higher. These are the main China ETFs, the A shares. A lot of them have all at or near new highs. The MCHI in particular, continuing after selling up just a bit yesterday, continuing this uptrend, new 12-month relative highs, relative RSI overbought again, but overall sign I would argue of a healthy market that's continuing to push higher and higher. That's our market recap for today. We need to take a quick commercial break. Back with my guest, Larry Tentarelli. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we look at these markets together using charts, using the power of StockCharts.com. As a reminder, we love to hear from you, feedback on the show, on our guests, on your host, but also questions that come up in your normal process of trading markets, investing, analyzing your own charts. So let us help you along the way. We're happy to point you in the right direction as much as we can. Our email is thefinalbar@stockcharts.com. On Twitter, @FinalBarSCTV, or on our YouTube channel, just put a comment below the video that you're watching. We'd love to gather your questions, and we have another mailbag segment at the end of this week on Friday's show. Love to answer one of your questions on the air. I want to welcome on today's guest, Larry Tentarelli. Larry is the publisher of Blue Chip Daily Trend Report, coming to us from the Boston area. Larry, welcome back to the show.
David, good afternoon. Thank you for having me on. I appreciate it.
Of course, earlier when I was introducing the show, I mentioned when I think of you and I think of all the charts that you share on social media, often when you share a chart, I kick myself wishing I would have found it on my own, because you just seem to uncover really good opportunities. We're starting now in the energy sector, which is, I know, an area that a lot of people have been focused on, starting with the XOP. What are you seeing here?
Well, a couple things. So right now, year to date, energy is the leading sector in the S&P 500 of the 11 sectors. And what's interesting about that is in 2020, energy was the worst performing sector in the S&P 500, and there were 0 large cap stocks that were positive for the year in 2020.
Right.
So I've got a position in XOP, and as you can see from looking at the chart, so I started my position in November, right when it closed over the 200-day moving average. And I really used the 40-week moving average, which is just a longer time frame. But when I took the position, and I've added to it on the way up, and it's trending higher, but that ETF was down 83% from the all-time high. It spent 2 years underneath the 40-week moving average. And as a technician, the longer that a stock spends underneath a key level or a key moving average, the more significant the close is above it. So I took the position coming over the 40-week. it started to work. I knew at the time it was a very high risk position because when they first come over that 200-day moving average, especially a declining 200-day moving average, it can be very choppy. But as it started to work, I've added a little bit more on the upside. And the way that I see it, just by looking at the chart, as long as it stays over that 50-day moving average, which right now is about 63.79, as long as it stays over that, then the intermediate term uptrend is intact. And then as long as it stays over 60, then I see the entire breakout is intact.
It's amazing how this sector and this group in particular has rotated from just this incredibly consistent downtrend to an emerging uptrend. I think you hit on a key point, which is looking at when it breaks the moving average as an entry point. Chart number 2 is looking at Square, SQ, obviously more in the technology space. A long-term uptrend. What are you seeing here?
Now, this is a totally different sector, totally different chart structure. But Square, so one of my favorite groups coming into the year and still is the e-commerce slash fintech subsector. So financial technology, e-commerce. And with Square, we can see it's just in a very, very strong uptrend. And Square is a stock that as it continues to move higher, it always looks very high. Like if you look at this chart, it looks high right where it is. But that consistent uptrend of higher highs, higher lows, and consistently higher moving averages stays intact. And I think where Square is, and with the world moving more and more into mobile payments and digital payments, I think that Square is still positioned technically very well.
You're right. I mean, it's a tale of two charts here. The energy first, and then looking at Square with SQ on a chart like this. Let's assume that you had amazing foresight. You bought back here in May, and you've ridden this incredible uptrend. At what point do you decide that this theme is over? Is it for you? Is it about breaking a support level? Is it about breaking the moving averages? Is there some other sort of input? Like, how would you go about locking in gains on something like this?
200. So I've had it for a little while. I have scaled some gains on the way up, but 200 really is the core number on the screen. So if you take a look, you can see in the third week of January, it didn't close. It tested under 200, but it held. Then before that, it held at 208. It held at 203. And if you go back to early November, you can see that 200 was a resistance area. So for me, the $200 level is a key line for Square. So as long as it stays over 200, I want to lean into the long side. Now, if the stock continues to go up, then that 200 number will need to move up. But for right now, and it just tested 200 a couple weeks ago. But for me, I always expect volatility. But as long as it stays over 200 here, then I want to lean into the long side.
So, having said all of this, we only have about 30 seconds left, Larry, but let's assume right now you have new money to put to work. Given how, the market has had such a run, stocks like Square and others obviously have had incredible runs, even, energy and so many. Are you seeing opportunities out there, and where would you be looking outside of the names that we've talked about so far? Or is it a wait and see mode to see how this euphoric sort of stage plays out?
I am seeing opportunities. So I took a position in Monday in Taiwan's semiconductor. So that's been working. So semis look good right now, but I rotated. So I had a semiconductor name that I had a profit in. I had Qualcomm, and Qualcomm started to break down after earnings. So I rolled that into Taiwan Semi. Semis are set up very well here. I think it's a good combination of growth, but I also think that the banks are set up well. I think the energy stocks are set up well. I still like Freeport-McMoRan, which we spoke about back in August, I think it is. But
that's right.
But with the VIX over 20, I constantly expect intraday volatility in these reversals like we've had. But I think that a commodity upcycle is still underway. So copper, energy, and I like tech, growth, e-commerce, and semis.
Larry, we'll leave it there. It's so much fun to have you on the show. I appreciate the charts that you brought and talking through how you're thinking of some of these. Hope you stay safe, you and those around you, and we'll talk to you again soon, all right?
David, thank you so much. I appreciate it.
That's Larry Tentarelli. Larry is the publisher of Blue Chip Daily Trend Report. Worth a follow on social media if you've not done so already. He shares a lot of great ideas, and good to hear some of his thinking behind the many charts that he shares. We need to continue on with the show. Our next segment is called Getting Sentimental, something we like to do on Thursdays because Wednesday to Thursdays, when you have a lot of this weekly sentiment data that comes out, it's top of mind for me. As I mentioned, I was interviewing Jason Gefford earlier today. Jason's from sentimenttrader.com and is one of my favorite sentiment analysts and followers. And so it was top of mind as I was looking at how some of the weekly data had updated. And certainly, I think some noteworthy changes in some of the sentiment readings that we've been talking about on the show for many months. We're going to use the sentiment indicator chart list that I normally use for this. If you want access to this, as a reminder, most of the charts that I show on here are part of the free chart pack that is available to StockCharts subscribers. The way you get to it, go to your member dashboard, click on chart lists in the upper right. I have a ridiculous amount of these, but when you get to the very bottom of yours, you will see a link that says manage chart packs, and you will see one that says like David Keller's morning coffee routine or something to that effect. One of those chart lists is this one right here called Sentiment Indicators. The first one is the VIX. Larry, my guest moments ago, just mentioned quickly about volatility. And, for me, the VIX is less of a timing tool and more of an anecdotal tool. It's a way of measuring just overall the conditions that we're in and what sort of volatility we're seeing. Think of this in general as the inverse of the S&P. It's sort of a normalized inverted S&P. So volatility tends to spike when the market's selling off. It tends to come off when the market's rallying. That's why it's tended to be called the fear gauge. There's that inverse relationship, and it makes sense. The way I've always explained it is, when you're scaling into a position, when you're accumulating a position, when things are going well, you slowly sort of accumulate, you add and add. But when things really look bad and you want to exit, it's very difficult. Most people don't just exit a little bit. They panic and they just exit a little bit. They panic and they dump everything. And that's why things, the markets go up the escalator and down the elevator is one way that it's been said. And that's why this the increase in volatility usually means a down market. That hasn't always been the case, though. And you've seen a bit of a disconnection between that inverse relationship. And we've seen that to some degree in the last 6 to 12 months for sure. But overall, it's worth noting that up until 2020, up until really the February market peak, the VIX sort of ranged between 10 to 12 on the bottom end, 20 at the most on the upper end. It was more in that 15 to 20 range when the market would pull back a little bit. That all changed in February to March of 2020 when the VIX spiked up to one of its highest levels in history. Since then, sort of the more normal, quote unquote, range for the VIX has been around 20 on the lower end and up to around 40 on market pullbacks, market sell-offs. Now, most recently, when we sold off and the S&P came down to 3,700, tested its 50-day moving average, the VIX spiked up to around 3,750. So not even back up to the 40 level. Now, however, we are back down to the lower end of that range. We're back to the level which is similar to the end of bull market phases. Having said that, it is not, I would not argue, a topping signal, because you can look here in August, we hit a VIX around 20. We even turned higher. You can see the VIX actually increased during that later stage, that last couple weeks before the September peak, which is really a consolidation phase, a time correction more than anything here in September and October. Again, we pull back to a VIX around 20 there in early December, continued higher. It was more of a sideways move. So the low VIX readings, in the last 6 months have signaled more of a sideways trend, less of a downtrend overall. So I think that's one way of maybe interpreting what we're seeing here. Chart number 2 is looking at the AAII survey. This is the American Association of Individual Investors. It's a subset of the retail investing community, tend to be more experienced investors. Average respondent is a retiree. There's a couple hundred respondents, and it's been going every week for decades. What's interesting is in the last week, we have finally rotated back higher. We've had this steadily declining bullish reading. It peaked out around 58% or so, I want to say, the first week in November. Since then, it's pretty much steadily declined, less and less bulls. And the last couple of weeks, it's actually been below 40% bullish, which is relatively low for this phase, this part of the bull market phase. That changed this week. We have over 45% bulls, which is back, more in the upper end of the range, more consistent with extended bull market phases. So more of a normal reading for where we're at right now in the cycle. I wouldn't necessarily consider this a topping pattern. I would say when we have huge spikes and when it gets above 50%, that's when you really have to start looking at the very limited number of times when that's actually happened. We're not quite there yet, but we're certainly heading more in that range. The next one is a really interesting. This is the Name Exposure Index, the National Association of Active Investment Managers. This is a weekly survey where money managers are saying how they're positioned with equities, long, short, leverage short, or flat. It's back up to 110% long equities. This is up from about 80% last week. So we had a big spike to around 115, 112, 13%, I want to say, about a month ago. From there, have tapered off and came back a lot. This is after the sell-off 2 weeks ago. This week, we've actually gone back up to 110%. That's probably the third highest reading in history. The highest reading back here end of 2017. The second highest reading was a couple of weeks ago when we were about 113, 115%. We're now back above 110%. This is actually incredibly rare. Usually only happens at the end of a bull market phase, not at the beginning. Finally, put call ratio, just for time, we're going to jump to the equity only put call ratio. I've highlighted just this horizontal line showing where we're at. We're certainly at the lower end of the range for this, similar to the VIX. So you can see the last couple times that the put call ratio has been below this reading was sort of early December before it, as I paused before we continued the uptrend, mid-January before the January pullback. So worth noting, we're back into that range again, not necessarily a topping signal on its own, but definitely tells us we're setting up with the conditions where the market is ripe for a decent pullback of sorts. For me, as always, sentiment is after breadth, which is after price. Price is most important. Let's look at the charts themselves and see when they break down. That is our segment, Getting Sentimental, updating you on some of the sentiment readings. Again, rotating from optimistic to more euphoric in some measures. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the Name Exposure Index. We just finished our segment, Getting Sentimental, and I think it's worth pointing out. Anytime an indicator is at the third highest in history, going back for years and years, I certainly pay attention to it. And again, for me, sentiment tells me about the conditions. It tells me about the mindset of investors. Breadth tells me about participation. Price itself tells me how people are voting with their capital. So at this point, you have price continuing to drift higher. You have sentiment readings getting back up to euphoric levels. That it raises a red flag for me, but I'm going to want to start to look at price and see what sort of pullbacks may be in store. Chart number 2 is technology. I talked with Larry Tentarelli earlier in today's show about a group within the energy sector and also Square within the technology sector. And I have to agree on the long-term story on tech. When I'm looking at the XOK, I'm seeing a stretch of incredible relative performance for about 2 years, if not much more, going into September of 2020. From there, sort of a sideways pullback of sorts in the relative strength as other things like energy, financials, industrials, and materials did pretty well there last fall. But from there, look at how the technology sector has rotated back up, making new highs and lows in relative strength. Once again, testing a new 6-month relative high. So overall, price in good shape, trend pretty positive. The relative strength starting to improve as well. Semiconductor certainly a big part of that success story right here. Finally, our third and final chart in the 3 and 3 is Merck. Highlighting an individual name again. This is not my average chart, not my favorite charts. I tend to be a trend follower, not a trend anticipator. But I always sort of run a bottom feeding screen, thinking if you want to buy weakness, where could you look? And I'm interested in the chart of Merck for this reason. If you take the adjustments out, meaning if you take the dividend component out and you look at the unadjusted data, so under the little underscore before the ticker of any symbol, you can see the March low, you take the high from the September peak, and then use the Fibonacci retracement. You can see the 61.8% retracement is exactly where we hit end of October. That lines up beautifully with the low from mid-June. And now all of a sudden we're right back to those levels. So the stock is oversold, similar to what it was at the end of October. It's pulled back to the Fibonacci support level around $74, which is the same thing it did as October. I'm seeing some similarities between now and what we saw going into a low before, a nice bounce higher. So in general, I like to own stocks where this relative line is going higher. But if you're more looking for a weakness and buying things before they emerge, a name like this might be something you look for as a potential upside opportunity. Folks, that is our show for today. Thanks so much for joining us every weekday after the close for the final bar. A special thank you to Larry Tentarelli from the Blue Chip Daily Report joining us from the Boston area today. New season of Behind the Charts coming soon on March 1st. Don't miss it. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.